Assalamu alaikum. Welcome to lecture 6 of financial reporting. Today we are going to go through IS2 inventories. This is a very short standard and one of the easiest standard you will come across in your financial reporting. So in this lecture we are going to go through IS2 inventories, what inventories meant, then the scope under IS2 and inventories. Then recognition and measurement. See, for any standard four things are very common: scope of the standard, recognition, measurement, and then presentation and disclosure. This you will see in all these standards. So first is measurement, then the costing methods. There are various costing methods to measure inventories, and cost formula, then net realizable value, and recognition, then disclosure of inventories, and finally we'll conclude with the syllabus, summary, and technical articles. So we start with inventory, recognition, measurement, and disclosure. So primary issue in accounting for inventory is the amount of cost to be recognized as an asset and carried forward until related revenue is recognized. IS2 provides guidance on measurement of cost, subsequent recognition as an expense, also including any write down to net realizable value, and cost formula, which may be used to assign the cost to inventories. So the scope, IS2 applies to all inventories except this financial instruments. IS2 does not apply because here IS 32 and IFRS 9 applies. Next, biological assets. You have to apply IS 41. And by the way, IS 41 is the next lecture. That is lecture 7, which relates to agricultural activity and agricultural produce at the point of harvest. The measurement provision of IS2 do not apply to agricultural produce after harvest and minerals and mineral products measured at net realizable value in accordance with the well-established industry practice. And inventories held by commodity broker traders measured at fair value less cost to sell. These two items we do not apply IS2 for measuring. Okay. Now, so inventories are assets that are held for resale in the ordinary course of business. Okay, inventories usually they are current. You do not hold them for more than 12 months. That's why in your statement of financial position you will see inventories comes under current assets. In fact, that's the first item. So we are holding it for resale in the ordinary course of business. And it is something which is in the process of production for resale. For example, finished good is inventory, work in progress is also inventory, raw material for manufacturing industry is also an inventory, in the form of material or supplies to be consumed in the production process or rendering of service. So remember these three definitions. Now, recognition and measurement. So measurement, inventories are measured at lower of cost and net realizable value. You have to see which one is lower. Is it your cost or net realizable value? This is the important thing in IS2. Okay. Now, cost. What is meaning of cost? Cost includes all the cost that are incurred in bringing that inventory to their present location and condition. Components of cost: purchase cost, cost of conversion, other cost. In your exam, you will be given this cost. Okay. You have to decide what to capitalize and what not to capitalize. Now, we'll go through the list. So under purchase cost, it is your purchase price. If you have any import duties, non-refundable taxes which you can't get back, they're non-refundable. It's your purchase cost. Then any transport and handling cost will be added with your purchase cost. Then if there are any trade discounts or rebate, you have to deduct it from your purchase price. So these four items are your purchase cost. Next, for conversion, direct production cost, then production overheads that are based on normal capacity, expected on average under normal circumstance. Joint product cost, deduct the net realizable value of byproduct. If there are any byproduct that comes, deduct the net realizable value of that. Then other cost, non-production overhead. only if incurred in bringing the inventory to present location and condition. Example, storage in whiskey distillers and specific design cost. They are necessary to bring the inventory to its location and condition. Next, borrowing cost in limited circumstances. This we'll see in detail in IAS 23, the borrowing cost. Now, this following expenditures are excluded. They are not part of cost. They are abnormal amount of wasted material, labor and other production cost. Storage cost unless necessary to the production process. See, if storage cost is necessary for the production process, it's a cost. Otherwise, it's an expense. Admin overhead and selling cost. So for service providers, if you are in the service industry, how do you measure your inventory? Because service providers, they do not hold inventories. They usually do not have. Then their cost of inventories are their labor. Okay, including supervisory personnel and attributable overheads. Any profit margins or non-production costs that have been factored into charge out rates must be excluded from inventory costs. So any profit margin have to be excluded from inventory cost, and also any non-production cost in the service industry will be deducted, will be excluded from inventory cost when you're taking the inventory cost. Now, there are two costing methods that are used. One is standard cost, one is retail method. So, standard cost, it takes into account the normal levels of material, labor, efficiency, capacity, utilization. Standards must be regularly reviewed and revised also if necessary. And as a management tool, this cost may need to be adapted to conform to IAS 2. Standard cost, we, by the way, study a lot under management accounting. Next, retail method. This method is suitable for inventories of large number which are rapidly changing items with similar margins, and reduces sales value by an appropriate percentage gross margin. This could be an average percentage for our retail department. This is a practical mean of measurement for financial reporting purpose. Now, cost formula. So, specific identification. Specific identification of individual cost is required for items not ordinarily interchangeable and goods and service produced and segregated for specific projects. Now, the formula. So, the formula are permitted where specific identification of individual cost to individual item is not practicable. Where you can't find the individual cost to individual item, it's not, then you have to use a formula. There are two formulas that are permitted according to IAS 2. FIFO, weighted average. FIFO is first in, first out. So in practice, weighted average formulas are likely to produce similar results when price changes are small. See, in your exam, they might tell you which one is better. This is also an area which is hugely tested, FIFO and weighted average. Average formulas are likely to produce similar results when price changes are small and infrequent, and then there's a rapid turnover of inventories. If price changes are not small, not frequent, not rapid turnover, then FIFO is better. FIFO will give better result. Okay. Now, so the FIFO formula. It assumes that items that has been purchased or manufactured first will be sold first. They go by this assumption. Next, inventory at the year end is most recently purchased or produced. Therefore, inventory that you will see at the year end is based on most recently purchased or produced. Because items that are there before in the inventory, they must have been sold. You purchase them and you're selling them first. Used, for example, basically this is used on the cars on a production line. The cars that they have produced first, they will sell it first. And cars that are later on the production line will stay there as an inventory. Next is retail produce with a sale by or best before date. If you are having that this has to be sold by this date or use best before this date, this type of items also use FIFO method. First in, first out. Weighted average. This is determined from the weighted average cost of items at the beginning and cost of similar items purchased during the year. May be calculated on a periodic basis or on a receipt of each additional shipment. Used for similar items that are used in production without regard to when they are received. Now, activity 1. So in activity 1, you have to calculate your gross profit A, B, total value of closing inventory using FIFO and weighted average. So it's about fair buying and selling DVD players. Okay, they have purchased, they have these purchases. They have set up the business on 1st September. They have purchased, there are 2 purchases done on 2 different dates. One is on 5th, next is on 16th. So if it's FIFO, we'll go by 5th September first. Whatever we have purchased, we'll sell, and then we'll use the remainder from 16th September. And if it's weighted average, we'll do the weighted average. Okay. So you have been given the quantity and you have been given the price per unit. Okay. And on 24th September, they have sold a consignment of 250 DVD players for 50. So if you want to see this 250, so under FIFO, they will first utilize against this 200 and remaining 50 they will sell from here. And how will they value? Based on the price. You see the prices are given. And we are going by weighted average. We'll see. So now let us do this question. So now let us first find the gross profit. I'm going to write gross profit under the 2 methods, FIFO and weighted average. So here I'm going to write FIFO and here I'm going to write weighted average, WA. Okay. And here proceed, because sales gross profit is proceed minus cost and cost. So what is the proceed? You are selling 250 DVD players for 50,000. So 50,000 is the proceed under both. Okay. Proceed is same. No impact. The change occurs in the cost. Okay. And there is a working for this cost. So I'm going to mention like this by writing a W, which is work. So here I'm going to show the working. Okay. This line would be the gross profit. And here I can start my working. Okay. Now, so when I'm doing the working, the units and the unit price. So now, first under FIFO, how much do I have? 250 I'm selling. So that 250 first I will utilize 200 under FIFO basis. And the price is 150. So 200 into 150. First batch. So now that 200 totally went. Now the balance 50 will sell from this lot, that is 80. And the price is 185. So 50 into 185 equals to 50 into 185. And now we'll use the sum function and get the total. So the total is 39,250. This is the amount that I have to deduct from here. So minus 39,250. Done. Using the sum function, I can easily get the gross profit. So under FIFO, the gross profit is 10,750. Now coming to the weighted average. Here. Okay. How do you get the weighted average? So for weighted average, this is how you get it. The 200 into the price, that is 150. And then the 80. Okay. 80 into 185. That was the price and the quantity. So you will add the total 44,800, and here remember the price, this is the unit. Okay, you also have to take the unit. So 280 is the total, 280. Okay, so now this is how you find out the price. Weighted average is a little more work to do. First you multiply. See, this is what you do. You take the quantity and multiply it with the price. That means 200 into 150 plus 80 into 185. But you add the quantity also because you need the price per unit. So this is what I'm going to do now to find the price per unit. It is this divided by 280, 280 and 160. So this is the price now I will use. You understand? 160 is the price. So what is the amount? You are selling 250. Isn't it 250 amount you are selling and 160 is the price. So it would be this that you are selling and this is the price. Basically you are finding this 160, the price you have to find out, and you multiply it with the amount that you are selling the DVD players, 250. So 40,000. So this is your cost which you will deduct from here and just copy drag it here. Automatically it is copied with the formula. So 10,000. You see you are getting a lower gross profit under weighted average. Now part A is over. Coming to part B. Okay. Part B, you have to find the closing inventory. Under both. So closing inventory. See what is left over. You have taken 200 quantity, you have sold the entire amount because 250, and then from 80 you have utilized 50. So balance remaining is 30. That 30 will be at the price of 185. So closing inventory under FIFO is 30 into 185. Done. This is the closing inventory according to FIFO. What about weighted average? Weighted average, this price only you have to use. So it is 160 into how much is remaining? Same, 30 only. So this is the amount. Okay. So this is the solution for activity 1 that we have just done. Okay. As you can see, this is the cost we have got and the gross profit, and this is the working where first 200 and then balance 50 from the 80. And here when we come to weighted average, we took multiplied and got, and 80 into 180 got this, got the total and got the unit total, divided for 44,800 by 280 and got 160. And what amount you are selling? 250 dividends. So that 250 into 160 is 40,000, and that 160 is again we are using here also into 30 because the total is 280, you are selling 250, balance is 30 that is remaining. Only the price is different. Okay, quantity remains the same. So now let us move on to the consistency. An entity must use the same cost formula for all inventories having a similar nature. For example, a similar nature inventory, you can't use one weighted average and the other one FIFO. If you're using FIFO, all has to be FIFO, and if you're using weighted average, all has to be weighted average. Different cost formula can be justified if inventories are of different nature or use. Now, net realizable value. So cost part we have finished because we told IAS2 recognizes inventory lower of cost and net realizable value. So whatever is included in that cost we have covered. Now let us move on to the net realizable value. That is the estimated selling price in your ordinary course of business that leads to an estimated cost of completion and estimated cost necessary to make the sale. That means, for example, if you are selling that inventory, what would be the amount that I will get today based on the cost. So the need for this, cost of inventory may not be recoverable. Why do you need realizable value? Because cost, you can't recover the cost due to damage that is done to the inventory, or inventory become out of date, or selling price declining, or there is an increase in an estimated cost to complete. Any necessary write down to net realizable value is usually on an item by item basis. See, when your IAS2 says lower of cost on net realizable value, right? If your net realizable value is lower, if you have to reduce it, and if you have to write down, that is the meaning of writing down net realizable value. If it's necessary, you have to do this line by line, item by item basis. If there are 5 stocks, for 5 stocks you have to separately do it. There's no grouping there. Okay. Assets cannot be carried in excess of amount expected to be realized from their sale or use. You cannot carry them in excess of the amount that would be expected to be realized from their sale or use. That means from their cost or net realizable value. It can't be more than that. Now, estimates of the net realizable value. You have to estimate that net realizable value. And when you're estimating, you have to take into consideration few things. First, fluctuations of price or cost relating to event after the period end and purpose for which inventory is held. Then materials. Materials for use in production are not written down below cost unless the cost of the finished products will exceed their net realizable value. Okay. See, the materials that you're using for production, you will not write them down to below the cost unless that cost of finished products will be more than the net realizable value. Then you can write below cost. Timing. A new assessment is made of the net realizable value in each subsequent period. So in each subsequent period, the net realizable value keeps changing. So when circumstances causing the write down no longer exist, that means your selling price increases, then you have to reverse your write down. Note that these reversals are very rare in practice. Okay, that means when your selling price increases, earlier you have written at the lower of cost or net realizable value. When your selling prices was less, now selling price increase, so whatever you have written down before, you will reverse it. Okay, but this reversal is rare. Why this reversal? Because every year you have to do that assessment, every subsequent period, whether the net realizable value is changing or not. Okay, now activity 2. So there are 3 products, alpha, beta, omega, with 3 different cost, 3 different realizable value and the selling expenses. You have to calculate the value of the closing inventory. So first, okay, the solution is given here. For alpha, okay, what should you do for alpha? See, selling expense you have to deduct from the realizable value and then compare with the cost. Okay, so 120 minus 25 is 95. It is lower than your cost. So for alpha, it is the net realizable value of 95. Already they have shown how 95, 120 net realizable value minus selling expense. Coming to beta. Beta, 60 minus 5 is 55. But cost is even less. So it is at cost 50. Coming to omega, 85 minus 15, it is 70 versus 75. So 70 is lower net realizable value. And the total is 250. Now, recognition. So 2 things. Either you can recognize as an expense or an asset. Very important. So when do you recognize it as an expense? When inventories are sold, their carrying amount is recognized as an expense in the period in which related revenue is recognized. Any write down to the net realizable value and all losses are recognized in the period in which they occur. Any reversal of write down is recognized as a reduction in expense in the period in which it occurs. And inventories allocated to the asset accounts, example self-constructed property, plant and equipment, they are recognized as an expense during the useful life of an asset. For example, any inventories that are there for self-constructed property, plant and equipment, they are not taken as inventory, they will be recognized as an expense. Now, as an asset, in some cases an entity, that is the seller, may transfer the good to another party, the dealer, or for onward sale to end customer. So this arrangement is very common in car industry where cars are legally owned by manufacturer but physically held by dealers. So the control of the good is not transferred to the seller. Okay, if the control of this good is not transferred from the seller to the dealer, they are classified as consignment inventory and remain as an asset of the seller. Remember, dealer has to sell it to the customer. If it is not, it is still remaining as an asset in the books of the seller. IFRS 15 gives guidance to help determine whether goods are consignment inventory or not. And IFRS 15 was the previous lecture, that is lecture 5. You can watch under my FR playlist. The link is given at the end of this video, and also you can click the I button on your right hand side screen on the top, and it will take you to my FR playlist where you can see my IFRS 15 under consignment. Okay. So indicators that goods remain an asset of the seller includes: the seller can require the goods to be returned to them, and they can choose to then transfer this to another dealer. Who has the right? Seller. And the dealer does not have an unconditional obligation to pay the seller for the goods. Dealer does not have that risk. So in this two condition, it will be recognized, the inventory will be recognized as an asset in the books of the seller. Now, disclosure. Accounting policies should note, accounting policies note should disclose the policies for measuring inventories, including the cost formula that is used, whether you have used FIFO or weighted average, has to be disclosed. So the carrying amounts to be disclosed includes total. Okay, that means raw material, work in progress. What is the total? Next, amount at fair value less cost to sell. Any amount pledged as security for liabilities. And the expense in the period should show amount of inventories recognized as an expense, amount of any write down, any reversal of write down recognized as income, and the circumstance leading to the reversal. Amount of inventories recognized as an expense during the period is often referred to as cost of sale, either by function format or by nature format. So by function format, cost of inventory is recognized as an expense, measurement of inventory sold, unallocated production overhead, abnormal production cost, and by nature format, operating cost classified by nature, cost recognized as an expense for raw material and consumable, labor cost, other operating cost. This is how it will be divided by nature and by function, or net change in inventories. Now, so we are still in section B, inventory. We have applied the principles of inventory valuation, and let us summarize. So we measure the inventory at lower of cost and net realizable value. Net realizable value is your selling price minus cost to complete and sell. Cost includes all the cost to bring the inventories to present location and condition. If specific cost is not determinable, you use FIFO or weighted average. In your exam, they will tell you which one to use. Cost of inventory is recognized as an expense in the period in which related revenue is recognized. Any write down is expense to profit and loss, and any reversal in the later period will be credited to profit and loss by reducing that period's cost of goods sold. You have to know this adjustments, by the way. Now, there are no technical articles on IAS 2. Thank you for watching, and I shall see you in the next lecture, lecture 7, that will focus on IAS 41, that is agriculture. So make sure that you watch my previous lectures as well, and you can do questions on IAS 2 right now from your revision kit. Thank you for watching.